I'm here in London's financial district, where equity trades worth £24 billion are made every day. I've got a sheaf of shares in a big company, but what are they worth? Well, that depends on what profits investors think the company will make in future. A share, remember, is just a promise. Once the company has met its costs, like wages for staff, it promises to split money it has left over between shareholders like me as dividends. Prices for shares go up and down on the stock market in tandem with estimates of future profits. So the commonest way of valuing shares is as a ratio of their price to expected earnings. Let's look at an example. Suppose I start a milkshake business. Customers love my milkshakes, so I start dotting the country with milkshake stands. The eternal optimists who work at stockbroking businesses and write reports about the performance of large companies predict that the profits I will make next year will be enough to pay dividends of £10 million, or 10 pence per share, because I've issued 100 million shares. This figure's called earnings per share. Because I've been doubling it every year, investors hope that I will continue, for example for 7 years. That would be an acceptable period to pay for a shareholding. Through the miracle of compounding, one share would be producing £6.40 of earnings by year 7. So investors should be willing to pay half that amount now, £3.20 per share, allowing for the risk that my business does badly. That would mean the share had a price-to-earnings ratio of 32 times, as illustrated by this exciting sum. That's about twice the valuation for the average company, which wouldn't be expected to grow so fast. The price-earnings ratio is a really good starting point for valuing shares. Lots of companies aren't valued this way, for example, loss-making tech companies. But we'll talk about that another time. Meanwhile, I've had an idea for a milkshake business, so I'm off to find some investors to fund it for me.